wondering, today's the 18th of December, so next Saturday is Christmas.
That's right.
We're not going to have a show.
We're going to have a show Sunday afternoon.
Oh, got it.
Yeah,
okay, so I want to make sure we weren't doing our last show of the year. And so the reason why I want to talk about it is what is happening in the markets. We saw, as we're talking about Christmas, the last thing we want to talk about is witches, but that's exactly what happened yesterday at the close.
Right. Friday was triple witching, meaning the expiration of stock options, stock futures. And that does tend to lead to a lot of volatility because dealers can have to square their books and don't want to take too much risk over the weekend. So that can generate moves that don't make any sense in the short term.
And there was some really crazy moves. We saw the S&P, for example, down 1%, while the Russell 2000 was up, and that generally doesn't happen.
No, it really doesn't. But what has been happening is throughout this year, as the S&P continued to make new high after new high, led by the 5 mega cap tech stocks we talk about all the time, small caps gradually started falling by the wayside. And they finally have gotten them all, essentially, in my opinion. Like we were looking at an oscillator, which basically is a measure of extremes, and it's very extreme on the negative side in small cap stocks, which is one of the reasons why we look opportunistically at things like that to take advantage of tactically.
So that could be a suggestion if you're listening to the show. Maybe you want to take a look at that for your own portfolio, and we are doing that here at Annex Wealth Management. But the big story, of course, was the hard pivot that we expected out of Jay Powell this week.
Right. The Fed basically did what most expected. They not only are going to continue the taper, they're actually going to accelerate it. So they're going to go from purchasing $15 billion less in Treasury securities per month to $30 billion, which means that at the current run rate, they would basically be flat. In other words, purchasing no more Treasury securities in March.
And let me try clearing that up. $120 billion a month was what was being purchased in Treasuries and mortgage-backed securities by the Fed in the open market. So they're going to taper that purchase from 120 $30 billion less, as you said, down to 90, and continue that pace until it gets down to zero. Obviously, they'll take 3 more months. That puts them in a position to do what?
Well, that would put them in a position to consider raising short-term interest rates, which they haven't done in many years. It's something that we have obviously anticipated. You've got a very strong growing economy. Corporate fundamentals are great. Household balance sheets are in good shape. The labor market is strong. So there really is no sense for the Fed to remain accommodative when the economy can stand on its own.
And so if the Fed gets to a point, and we'll have to see what happens once we get there in 3 months or 4 months from now, interest rates still are low. They're not raising interest rates. And ironically, the 10-year Treasury, even on this news, went down.
Right, which has a lot of people a little bit perplexed, because you would think that with this kind of growth, with the inflationary numbers we've seen recently, that inflationary expectations would be going higher, forcing interest rates higher as well. And that hasn't been the case. The 10-year is at 1.4 at the close on Friday, lower than it was when Jay Powell was speaking on Wednesday.
Yep, that's for sure. So we're watching that. And obviously this pivot was because, of course, we've talked about this over and again, is that the Fed has 2 jobs. One of them is to get to full employment. You can make the argument is that we are at full scale right now with the unemployment rate where it is. And of course, their second job is controlling prices or inflation. And that is ugly because it's a number we haven't seen in nearly 40 years.
Right. We had a PPI that was 9.6%, which was ahead of expectations. We had a CPI of north of 6%, both very strong numbers, fueled in part by supply chain bottlenecks and the rest. But there are persistent elements to inflation that continue to be there as well. Wage growth being one, owner equivalent rent being the other. The key with owner equivalent rent is it tends to lag the increases you see in housing prices. And that was further stimulated by some of the restrictions on evictions that existed during the pandemic. So those 2 factors ought to continue to put upward pressure on the CPI, while some of the more transitory factors like used car prices, hotel reservation costs, and so on.
Energy, autos.
Right, start to anniversary against tougher and tougher comps and have less of an impact.
That's right. So we'll have to watch that very closely, Danny. And as you know, if you listen to the show, we suggest that you know what you own, why you own that particular security or mutual fund, and how much you're paying for it.